Well, I think it's interesting that the pullback from the highs has really been a sideways consolidation pattern. In the past, we'd see prices break to new highs and get smashed immediately, and that's not happening this time. I think one thing of interest that almost nobody's looking at is the yield on Japanese bonds. And why that's important is because the yen is the carry trade. I mean, that is the foundation for the global carry trade. And you've had yields. I mean, you've got what 320 or thereabouts on the 30-year and 160 plus on the 10-year. Those rates were point 0.2 or lower 2 years ago, and they were about half of those levels, pretty close to half of those levels at the beginning of the year. So yields have really blown out in the Japanese bond market, and the carry trade is becoming unprofitable from its base. And what that means is a lot of the carry trade, the longs, once you get participants closing out the funding side of it, then they close out what they're carrying. So it really does have the potential to blow things up and turn this into a domino market of all markets to the downside, because literally anything and everything has been bought up by funds created through the borrowing of basically a 0% interest currency. That's no longer zero. So there is a cost. There's a big cost now for them to carry.
Well, that certainly is the case. And Bill, in response to that, I'm wondering, do you load up your portfolio with 30-year Japanese bonds, or do you figure I want a little extra duration, give me some more, and you go for the 40, which who is it? Austria that has the 100-year bond, is that right?
I think it's Austria, yeah.
I mean, maybe I don't want to meet the guy that's investing in the any 100-year bond in today's environment, but such is the world we live in, Bill, and I know what you mean. And it's not all that different with the U.S. long-term yields, maybe not as extreme as Japan, but certainly they've been climbing as well. That's here we go with the U.S. 10-year has been, yeah.
On the on U.S. Treasuries, understand that what was it, a year and a half, 2 years ago when they were going through a year and a half when they were going through the cutting cycle where they cut rates a full percentage point over three meetings. Market rates went up by one full percentage point. So market rates did the exact opposite of what the Fed did. What happens if they do this, if this happens again? Because we're going to go through another cutting cycle. Uh, Yesterday, Lisa Cook, one of the Fed governors, it looks like she's going to be fired or at least hamstrung. And it's going to end up, Trump's going to have a majority on the Federal Reserve Board. So he's going to get what he wants, which is lower interest rates. And lower interest rates also means a lower dollar. But the question is, what does that mean for market rates? Do market rates go higher? If they go through a cutting cycle, rates again, that is absolute illustration that they've lost control of the yield curve.
Yeah, I know what you mean, and I will pull it back up here because here we can see on the 10-year chart, there was in September when following last year's July meeting where we don't really need to cut anything, and then now we need to cut 50, which despite the economy being strong, while inflation was already above its mandate for going on 3 years back then, now we're on to 4 years, and it seems like September might just be Jerome's favorite month. And actually, all right, we'll go to this right now. We got silver added to the draft list of critical minerals in Saudi Arabia. and a bunch of other stuff. But Bill, some of these clips here were rather confusing. I'm going to play a couple of them, and I'd love to get your comments on these. So let's take this is from
Who is who was the rocket scientist in Saudi Arabia that decided to buy paper silver? I don't get it.
well, Bill, I can't understand why they didn't call you because I know you help customers safely and securely secure their metal. Securely secure their metal. I guess maybe that was figure out a different phrasing, but we'll come back to that. Although it is interesting because while everyone assumes that the only one buying silver in 1980 was the Hunt brothers, if you remove a bit more space dust from that novel, there were Saudi Arabian people, investors, and involved as well. But we'll come back to that, Bill, and hopefully this will give any Saudi investors watching today's show, they'll be able to warm up and say like, "Hey, I should call Bill." But let's hear from Jerome first here, my friend.
Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending.
Now, Bill, where do you think the chances that there could be some connection between what he said, the layoffs, let alone the inflation of the past couple of years, to the slowdown in consumer spending? You said it's an odd balance. What would you say to that?
I would say go look in the mirror. You did it. I mean, maybe not him personally over just the last few years, but it's the system itself. And think about this. And one thing I pulled off from that is he's talking about the economy's growing at 1.2%. What's the growth rate of Treasury debt? What is the number? I'm guessing it grows at what, 7% plus per year?
Didn't they hit over $1 trillion in the most recent quarter?
Well, yeah, they're over $1 trillion on interest paid, and I think for the quarter it was $1 trillion because the first quarter or the quarter prior to that they borrowed way less than they had anticipated and then jammed it all in the first week or 2 weeks of the next quarter. But my point being, if you've got debt rising so much more rapidly than you do the economy, the real economy, to support the debt, to support the cash flow and thus the interest payments. It just seems to me that that's a mathematical equation. You can't do that. And we've known this for years that, any household that operated like the Treasury would be either bankrupt or in jail. So I think you need to ask yourself the question, if we're running a deficit of $2 trillion per year on an economy, what's the size of the economy now? Close to 30 trillion? Yeah. That's 6-7% deficit per year. What would the economy do, or what would it have done if it wasn't for that additional spending of the $2 trillion that was borrowed by the Treasury? What would the economy have looked like over the last 10, 20, 30, up to, call it 60 years or 60 plus years? Because we've deficit spent every single year. I mean, back in the old days, when I say the old days, I'm talking about the 40s, 50s, 60s.
Wow.
It was, oh, that's like ancient days for you, Chris.
You're around in the 40s, Bill? Goodness. Is that the 1840s or?
My point being, deficits were supposed to be used during bad times to goose the economy. And then we were supposed to run a surplus during good times to save up for the hard times. Well, for 60 plus years, it's been nothing but deficit spending. And I would ask you, what would the economy look like had there not been any deficit spending?
So are you suggesting that borrowing $100 to make 50 is not the ideal structural arrangement?
Right.
Okay.
You're absolutely right, but that is the structural arrangement.
Well, Bill, I think you're going to be darn well qualified. You might even be able to explain this next one to me, which is where I continue to get confused. But I did go to business school, so that'll set someone off course quite a bit. But that's why we got Bill Holter, anti-business school, in the house here today. So here next, he's explaining inflation. You're going to like this one.
Another possibility is that inflation expectations could move up, dragging actual inflation with them.
It's possible they could go higher. Transitorily, of course, but
inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem.
Whoa. One-time increase in the price level to become an ongoing. Here's our CPI index. It's up 26% since May of 2020. And that's with numbers so fraudulent that Trump just fired the guy who compiles the labor numbers. And let's just say these aren't much better, but one-time price increase, we can't let that become ongoing. Earlier in the clip, he mentioned how we're 4 years into being well in excess of the Fed's mandate. And how is he going to solve this? By cutting interest rates. And I'll pull up the futures curve, but it looks, I'm hearing a lot about 50 versus 25. So which part of the math am I missing there, Bill?
Well, you're exactly right. If he's talking about cutting rates, but inflation could be a problem, I mean, it's what the market's already told them. Told them a year ago when market rates went higher, and after they cut interest rates. I suspect that's going to happen again. I think we're going to have a weak bond market in this cutting cycle, and it's math. I mean, if I was there, if I was a journalist asking questions, I mean, there's so many questions you could ask him, but the biggest one of all is, isn't inflation a result of monetary policy?
I don't think he believes that, or at least
inflation is a monetary event. Now, one thing he said was a one-time price increase. The only two things that could come to mind would be all of a sudden stuff costs more because of tariffs, or is he talking about a reset? Is that what he's talking about? I don't really follow what he's talking about, a one-time price.
I think he was saying they're not going to, have some big jump. They're going to be vigilant and on it, which, sounds great. But it's like, all right, we're all still paying for the last one that still has not gone down to their mandate yet. Right. We're going to cut away. Although, Bill, this one I think might have been a slip of the tongue, but it makes it even funnier when you hear it. So this is your birthday present. Don't say I didn't get you something this year, because
in particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time.
What? Oh.
In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time.
So I'm assuming he meant to say lower on one half of that, because, right. I mean, certainly flies in the face of the other one that we just heard as well, where we're not going to have it above 2%.
Yeah, I think he just misspoke.
But Bill,
I mean, if he really meant that, then he's babbling.
but why is there not the adjustment when we've had the inflation surplus? In his May speech, he talked about, and he was talking about inflation targeting, basically raising the mandate because they came up with the new buzz phrase. Just imagine this was like tested in front of market groups and like, how do you feel about inflation deficit? Or, it was an inflation shortfall. So he introduced that earlier this year, saying if there's an inflation shortfall, we'll run the thing hotter. But what about the inflation surplus that we still have? Where's the undershoot for that?
Right, there is none. And one thing you'll never hear a Fed chairman talk about is they constantly talk about CPI, PPI, because those are the government figures. I would say all you need to do is look at markets themselves, and there's your inflation. I mean, you've got inflated equity markets all over the world. You have interest rates way below what would be considered normal historically, going back hundreds of years. The low interest rates are